So today we're going to talk about 3 signs you are not ready to buy a house. Yes, we got to talk about this because this is something that I look at every single day, and I was like, you know what, I'll just do a video on it and then people will know and they won't be so nervous and they'll know like, okay, I definitely need to work on that. So when I'm looking at a pre-approval, I'm looking for 3 big things. I'm looking for credit, assets, and income stability. Yes, credit, assets, and income stability. So today I'm going to talk about 3 things that can make it so you don't shine in those categories. So let's start with assets. Now, you don't have to be super rich. I'm not looking for $80 billion. I am looking to make sure that you're properly managing the assets you do have. So one thing that I've seen a lot of in the last few months is bank statements that are overdrawn. And I totally understand how people can there's not a lot of budgeting going on in the United States right now. And if, for instance, you're like, shoot, I thought I had $100 in there, but I only had 80. And then the problem is that if you spend $100 and you only have 80, then you're getting an insufficient fee from your bank, which is another 30. And then until you put more money in that account, anything that tries to clear is getting hit with those insufficient fees. So you could have $10, $2 charges that end up costing you $300 because of insufficient funds fees. So whenever I see overdrawn bank statements, that is a red flag for me because I don't know, it's not something easy to justify to an underwriter. It's hard to say to an underwriter, hey, look, yeah, they can't manage their checking account, but they're totally gonna pay this mortgage. Don't worry about it. They're gonna pay the mortgage even though they're $500, $1,000, $2,000 overdrawn. So you really want to be mindful of what's going on with your checking account and make sure that you're not overdrawn. So as a lender, I'm always going to be looking at your 2 most recent bank statements. However, a lot of these bank statements will say year-to-date insufficient fund fee. And if I see that insufficient fund fee, I have to get a letter of explanation from you. And if it's a repetitive behavior, it is definitely something that can affect your ability to get a loan. Okay, so the first thing is you want to make sure that the assets you're having, you're managing properly and you are not overdrawing your account. Okay, and sometimes it can be as simple as setting up, so that your savings takes over, or if you don't have savings, there's great apps you can get that alert you if you're getting close so that you don't end up overdrawn. So there's really no excuse in today's day and age to be overdrawn because there's so many free ways to get notifications so it doesn't happen. So number 1, manage the assets you have responsibly, appropriately, and make sure anything with your assets have a good explanation. I forgot, or oops, it doesn't work, because an underwriter's looking for stability. Okay, credit's another one. So a lot of times people are like, well, it's all about the score, right? Well, the score is a very important factor of it, but we also have to look at how you've been using your credit. And one of the things that I see a lot is I'll see someone who may not have paid a credit card in a year and they're applying for a house. And the first question I always ask is, hey, how am I supposed to tell an underwriter that you're going to pay your mortgage when you won't even pay this credit card? Right? That's the type of stuff. And it's not us trying to be mean. It's just literally the underwriter's going to ask me because they have to. This is guidelines. And also it's common sense, right? It's common sense. If your friend Paul is not paying back your friend Jane, do you want to lend money to Paul? I don't know. I don't think you do. So that's something you want to be very aware of. If you're currently delinquent on credit cards, if you're not paying your bills, getting a mortgage, it's not the right time. You need to catch up on your bills, make sure you're up to date on your credit cards, because saying that you don't want to pay that credit card but you'll pay a mortgage, it doesn't work. Now, the other thing I want to bring to your attention is forbearance. Yes, forbearance, the F word, as I love to call it. Forbearance is something that we've seen a lot of people enter who have needed it, and it has been an incredible resource for that. If your job got affected, it's great. I think it's amazing. I think it's fantastic what our government has done. Now, what we also see though sometimes is we see people who are in forbearance because they think it's a financial benefit to them. They haven't lost their job, there's been no change in income, and they want to buy another house, And the issue is that if you're telling one mortgage company you can't pay them because of COVID, as a new mortgage company, why would I think you would pay me? Right? The stories have to match. So if you can't afford to make your payment with that company, then you can't afford to make your payment with me. It's that simple. And it's one of those things where I'm always like kind of shocked by it, you know, because then people will be like, oh, well, yeah, I just wanted to take a break. Okay, well, that tells me as a mortgage lender that you might just take a break from me as well. And if you need the help, fantastic, take advantage of it. But if you're going into forbearance to save money for a down payment for another house and you want to buy another house while not paying that mortgage, it's a hard no. It's a hard no. So you guys want to be very mindful that underwriters are looking at your full financial picture. And with stuff like debts that aren't currently being paid or stuff that's being delayed, there is always a question. Now, if your student loans are deferred, that's a totally different situation. You know, the country, if you call the government student loan site, they say they're deferring everyone. So stuff like that, or income-based repayment programs, that's nothing to be alarmed about. It's just if you're not currently paying your credit cards, if you're not paying your car payment, you know, if you're behind on your bills right now, it is not the time to buy a house. It is time to get your financial house in order and then try to buy a house. Okay. That also ties into co-signing. So I just wanted to bring this up, and I just thought of it as I was sitting here, but I'll see on people's credit reports like tons of lates, and I'll be like, oh my God, what is going on? Why won't you make your car payment? And they're like, oh, it's not mine, I co-signed. Well, here's the thing with co-signing, guys. You told that lender that if that person didn't pay, you would step in. That is what a co-signer is. You guys are signing on to someone with like bad credit or not great credit or who doesn't qualify. You are saying to that lender, you will step in if they don't pay. So a lot of times people go, well, I just co-signed, so just you don't need to pay attention to it. And it's like, no, sorry, I have to pay attention to it. It's on your credit report. It's affecting your credit report. And you told that other lender that if Bob didn't pay, you were gonna step in, and you haven't. So I'm not a fan of co-signing. If you haven't seen the video, Google Jennifer Beeston co-signing. I hate it. I hate it so much. I will never co-sign for anyone. No way. No, nope, not even my kid, nope. Okay, so credit, great. So we did assets, we did credit. Now, the third thing is income stability. So income stability is very important. If you're getting a salary, income's usually pretty darn easy. It's like, okay, you make 50 grand a year, fantastic, we'll use 50 grand a year. Where we start to see income stability issues are in two separate categories. Hourly workers, actually more than that, hourly workers, commission, and self-employed. So with hourly workers, if you just started a new job and your hours are like 20 hours this week, 40 hours this week, 10 hours this week, we don't have enough information to make a determination that you are what your income actually is, right? And that's why lenders are always looking for 2 years averages if you're an hourly worker and you're not working 40 hours a week. Now, if your employer will say you're guaranteed XYZ hours, great, we can use that as long as your pay stubs back it up. And this is very important because this is one of those things that I have conversations about at least once a week, where someone says, well, I look at the pay stubs and I say, look, this one's 36, this one's 38. I need to do a 2-year average. I need to, get a full verification of employment written so that I understand your income, because I don't want to qualify you off of any of these numbers. I need to do my homework. And they'll be like, oh, my employer will put that I work 40 hours. I just sometimes take time off. Doesn't work. Doesn't work. I mean, if I hand to an underwriter a verification of employment that says you work 40 hours a week, but none of the pay stubs add up, it doesn't work. It doesn't match. It has to match. We're like always playing the match game. So if you have hours that are all over the map, it's very important that we're looking at a 2-year history. Now, if let's say sometimes it's 60 hours a week, sometimes it's 20 hours a week, and the employer will say it's a minimum of 20, and you always have at least 20, I can use that. But more often than not, what I see is we're gonna need a 2-year average. So it's very important to be mindful of that. If you're a 40-hour worker and you want to be qualified as a 40-hour worker, I encourage you to work the full 40 hours. You know, working 36, 34 throws us into that averaging situation if you do it, you know, consistently. Okay, self-employed. Self-employed's another one. So if you recently became self-employed, I can't use your income. No, there's certain circumstances where we can use self-employed income after a year of filed tax returns, but the general rule is 2 years. So often people will go, oh, I just started a new business. I'm making $100,000 a month. It's awesome. And I'm like, cool. When did you start the business? 3 months ago. Can't use it. Can't use it. Can't use it. You could show me $100,000 a month for 3 months. I can't use it because the bottom line is we have to look for income stability. A 3-month snapshot, a 3-month snapshot is not a good view of stability. The overall rule is 2 years for income stability. The exception to that is like, you know, let's say you were a W-2 architect and you set up your own architect firm and we have a year of tax returns showing how you treat that income. Fantastic. And if people go, well, why do you need the income? Why do you need the taxes? I can show you the income right here. Well, I need the taxes because I need to know how much you're going to write off, because that's the other thing we often see with self-employed borrowers is since they're self-employed, they have more expenses or they're showing more expenses on their tax return. So even if what I see coming in is $1 million, I could look at those tax returns and it could be $10,000. You guys think I am kidding? I see it all the time. My first question for self-employed borrowers is, do you write off all your income? And it's not because I'm being rude, it's because in my experience, a lot of people do. So let's just start there. Do you write it all off? Okay, great. That's not super helpful. So self-employed income, we're looking for 2 years worth of stability. So if 2018 was great, 2019 was terrible, we're looking at the terrible. If 2019 was terrible, 2020 was great, please file those taxes so I can use that 2020, because we're generally going to be looking at 2-year averages. In some cases, we'll do a 1 year, but you really want to be prepared for that. Commission. Okay, I'm sorry, it's another long video. I promised people I wouldn't, but commission. Okay, so with commission, we're really looking for that 2-year history because we have to be able to show income stability. Commission can vary dramatically, especially in certain professions. It can be seasonal. So if you just switched from W-2 to a commission job last month, we can't use that income. We're gonna need that 2-year history. And one more, I'm trying not to sneeze, sorry. Per diem. Yes, if you are in a position where you are per diem, that is another one that's going to trigger a 2-year history. So it's really important to note that you want to have income stability. You want to, you know, be current on your bills. Show the underwriters that, hey, look, I can manage my debt, I pay my debt, I'm responsible with my debt. That's what we're looking for, because we want to make sure you're going to pay us, to be blunt. And then thirdly, with your assets, you don't have to be a billionaire. I am not looking for $1 zillion. I am just looking to see that you're managing the money that you have and not being overdrawn. So I hope this video has been super helpful. As always, if you liked it, please hit the like button. If you want more mortgage information or kind of 101 on all this budgeting, grown-up adulting stuff, please subscribe. And yes, I am licensed in 46 states to do loans, and my team and I would love to help you. My team is getting bigger every day, so I have lots of mouths to feed, so please give us a call. Thanks for watching.